So we're now moving on to the last section in the AC 548 module, where we're looking at the area of financial accounting. Now, sometimes this is also called financial reporting, which essentially is the preparation of financial statements. And that's what these couple of pre-recorded lectures are going to look at, a couple of short snippets looking at some of the key financial statements. And in this particular recording, we're going to introduce the area of financial accounting, the role of the audit, and how everything kind of sits together before we start looking at the financial statements. When we get to the live classes then in weeks 8, 9 and 10, we're going to focus on the second part of this section, which is known as financial analysis. Some people might call it ratio analysis, where we're going to take a set of financial statements, and hopefully by then we have an idea what they mean and the way they're structured, and we're going to interpret them. We're going to analyze them and see what we can understand from them. So a very important skill for managers, and it's a separate area than what we've covered in sections 1 to 4, which was management accounting. Now we're moving on to financial accounting. So the last week, the last live class we had, we looked at the area of performance measurement. So essentially thinking about how do we measure performance in an organization, and particularly how does that link into the use of accounting. We looked at the areas like balanced scorecard, and we also looked at, I suppose, the role accounting plays, and particularly that merchant article that's on Loop would be very good suggested reading for that topic. We're now for the next 4 weeks. So I know week 7 we don't have live class, but these kind of short pre-records are trying to set us up for weeks 8 to 10 so we can hit the ground running. We're going to look at what is financial accounting or financial reporting. How does it differ from management accounting? And particularly we'll look at financial reporting. Where does the regulation come from? Because financial reporting, its output, is a very standardized set of outputs, which is called financial statements. We introduced those briefly in week 1, looking at Ryanair, for example, and Apple Green. What do the financial statements look like? We're going to go through it now over the next 2 or 3 recordings, look at each of the financial statements. What do they mean? What is in there? What isn't in there? And what are its limitations? And we'll talk a small bit then about the annual report. We're going to give you a couple of annual reports on Loop to have a look through, which is one of the main communication sources companies have to communicate to stakeholders. And that's going to become even more important now when we're looking at the sustainability agenda and the focus on more ESG criteria, so environmental, social and governance. And when we then get to weeks 8 to 10, we're going to focus on ratio analysis, otherwise known as financial analysis. How do we analyze a set of financial statements, and what help can it give us? What can it identify for us? So for now, we're really just introducing the whole idea of financial accounting. I put this slide up in week 1, and we talked about the different uses of accounting information and why each user might be interested in accounting information about a business. For all intents and purposes, for the first couple of weeks in the module, we focused on internal use of accounting information, costing, budgeting, decision making. And that's really about the internal use of quite sensitive information, commercially sensitive information, but it could be sliced and diced anyway because it was only ever within the organization. Now what we're thinking about is, well, there's a whole other cohort of stakeholders, competitors, the government, shareholders, banks. They're going to want information as well. And the way accounting is set up is that they're external stakeholders. And what accountings do then is say, well, we're not going to tailor financial information to every single stakeholder. It wouldn't be realistic in terms of a cost benefit. So what we're going to do instead is we're going to do a standardized set of financial information, which is what we call the financial statements. And that's one of the key differences between management accounting and financial accounting. Management, internally focused, very flexible, can be future orientated, can be present orientated for decision making. It's not required, so you don't have to do it by law, but it's useful to support decision making. On the other hand, financial accounting is heavily regulated. Standardized output has to be done, otherwise you're breaching company law. And it's very much historical focused. It doesn't look to the future, and it's not done every week. It's done on an annual basis typically, unless you're a listed company. If you're a listed company, you're probably going to report quarterly because the public, the shareholders, investors will want information on a more frequent basis. So it's a completely different setup. We're still using accounting figures. And just bear in mind, the management accounting system in an organization typically feeds into the financial accounts. So you'll have management accounts that'll do sales and costs maybe on a daily or weekly basis. All of that will be aggregated up typically in the system internally towards producing the financial accounts at the very end. So there is a link between them, but the key point is financial accounting does serve its own purpose over and above what management accounting is there for. And that really kind of the need for financial accounting stemmed from two aspects. One was the separation of ownership and management. Now, back decades ago, separation of ownership management wasn't really a huge issue because most smaller businesses were owned and managed by the same people. So you didn't really too concerned because anything that was going on, the person that owned the business was heavily involved. But as we started to get a more focus on capital markets, we started to have more listed companies, so being PLC companies, you started to have this separation of ownership and management. So the people that run the business day to day are not the shareholders or are not the only shareholders because there's thousands of others that are accountable to as well. So this whole idea of financial accounting statements is to provide an idea of stewardship. So they're a mechanism for accountability between the management who are involved in the day-to-day running of the business and the owners who again may not be involved day to day, but they have the financial consequences. So again, there's a logic there of using financial statements as that mechanism of accountability. And the other thing as well is there are different stakeholder groups. A lot more stakeholder groups want information now. The government want information, customers, society in general, the public, all of these stakeholders are demanding more and more information. So that really is seen more need for transparency. And with the improvement or development of international accounting standards, we're seeing a lot more disclosures. Right? Historically, it's always been associated with traditional commercial business sector, but now there's an increasing demand because of charity scandals, because of scandals, for example, in sporting organizations, there's a need for accountability in the public sector, so public sector accounting, but also not for profits. Charity regulations now and governance requirements rely on the publication and I think we're going to introduce in a minute the auditing of these entities' financial statements. So it is a very important mechanism right across society in terms of holding people to account and in terms of looking at this idea of stewardship. Is an organization, is an entity being run effectively and well? And just to show you some examples, like financial reporting is in the media the whole time. There's always headlines coming out to say if a company releases a new set of results, does that impact the share price? So, for example, Glanbia drops as they issue a new trading update. Trading updates are financial accounting information. You have semi-state organizations, the ESB, that could again be paying dividends up to the state. All of that comes from the financial results. So what we're trying to show you here, for all intents and purposes, a lot of the media reading is financial accounting information. Right? And particularly most companies that operate in Ireland, they have to submit their accounts to the CRO. So for example, you'll see that Noonan headline that I took there. I got the set of accounts from Noonan, even though it's not a listed company. As far as I know, it was taken over by a South African company a couple of years ago. You can still get their accounts. If you know the company's number or you know the company's name, its exact name, you can go onto the CRO website, the company's registration office, and you can actually buy it for €2.50. So €2.50, you could buy a set of accounts, or if you want to figure out who the directors are or who the shareholders of a company are, you can go on and pay €2.50. So it's the company registration search engine. And that's one trade-off. If you want to have limited liability, setting up as a company, if you want to pay the lower rate of tax, corporation tax, 12.5%, or 15% now it'll be for bigger companies. There still is the 12.5 for the smaller companies. Um, you have to be able to disclose your financial statements, and they disclose those through the CRO, which is available to the public, albeit at a fee. Right? So where does the regulation come from in terms of financial accounting? Well, one is legislation. Companies Act, EU law requires the preparation of a set of financial statements for companies and submitting them to the CRO. If you don't do that, you can be in breach of company law. So the directors of a company who have a big responsibility, they can actually be held to account. Right? Fines, you can be disqualified as a director, and they have significant consequences. If you're listed on the stock exchange, say Ryanair, Glanbia, Kerry Group, stock exchange will have regulations, particularly around more frequent accounting information. So if you look at Ryanair, you look at Glanbia or Kerry Group, they'll publish financial accounting information, usually quarterly. That's dictated by the stock exchange because they want more regular information. Accounting standards issued by either the International Accounting Standards Board for EU and a lot of global, or the Accounting Standards Board in the US. They have their own set of financial standards. These are hugely important They standardize the way we can account for particular things. And there's been huge changes in the last decade around how we account for revenue, which is relevant for every business, how we account for leases, huge changes in like the airline industry, and how we account for what we call financial instruments, which essentially loans, etc. Huge changes in the banking and the financial services industry as well. But that's dictated to have standardization. The big difference is the US have a separate set of standards, albeit similar to most of the rest of the world. And finally, then industry regulations. For certain industries, maybe they're regulated, think of banks or insurance or even utilities, they can have extra disclosures or extra accounting requirements. But you might also have, for example, charity regulation, where they require financial accounting published in a particular way. That's become very important and pertinent in recent times, where we've had all these accounting scandals related to charities as well. So why is it needed? Well, hopefully a lot of it should be relatively obvious in a sense that, look, there's a greater risk here if the directors are going to adopt accounting policies that are going to give, I suppose, a distorted view of the financial health of a business. And if you're investing money, particularly if it's a public company in that, you can end up losing a lot of money, right? So you want to make sure there's comparability and there's integrity with the financial statements, because a lot of people are making decisions based on those. It gives greater confidence to the financial markets. Now, there's a role here for the audit. That's how I have it in red. We're going to talk about that in a second. The audit gives a bit of confidence as well, because remember, the financial statements, if they're not audited, are just prepared by someone who maybe has skin in the game. So maybe they're incentivized to manipulate the profits, manipulate the assets. You need a third party to review that, which is where the auditor comes in. It's helpful to build relationships with stakeholders. If you're raising money, investors will want to see the financial statements, or relationships with other stakeholders, employees, customers. That element of transparency can help cultivate those relationships. And it's important that you have meaningful information for users. So this whole idea of regulation, it says we want it in a meaningful way. We want to present it in a way that users of financial statements can understand and that's comparable across time, across different years, but also comparable across entities if you want to benchmark them against each other. So regulation does play a very important part. And as I mentioned, recently we've had a lot of changes. A lot of new accounting rules, a lot of new accounting standards, tougher regulation, particularly in the not-for-profit sector in terms of transparency, charities. And that's going to come even further now when we start to see, for example, non-financial reporting information. We're seeing now at an EU level mandatory disclosure of non-financial reporting information. We're starting to see at a global level new accounting standards for non-financial information. So sustainability accounting or CSR accounting or ESG accounting. That's going to become the next big shift now in the accounting landscape is how do we standardize non-financial reporting? So the environment, social and governance, and how do we verify it in terms of audit? And that's a tricky one is does the big four accounting firms or the big 10, do they have a role to play in this? Or is it different firms that have different expertise come in? But we need some information in terms of transparency on it, but we also need some standardization to make sure there's not this element of greenwashing or anything going on where there's, I suppose, misinterpretation or miscommunication of information intentionally to give a different image for the business. So one activity that's hugely important, that's a huge industry in itself, the whole idea of an audit. So before we had auditors, the whole idea was the company prepared a set of financial statements and the users of accounting had to rely on that. But of course the problem is you had no idea, well, these guys have an opportunity or an incentive to boost profits or massage profits or overinflate their assets. So there needed to be some element of verifiability or checking going on. And that's where the auditor comes in as an expert independent, they're supposed to be third party, they come in and they look at the underlying books and records of the company. And the key thing is they show is the accounts giving a true and fair view and whether the company kept proper books and records based on company law. So they essentially have to go in and they have to look at their accounts and sign off on them. So you look at some annual reports that we're looking at in a second, Ryanair, Glanbia, there will be an independent auditor's report. So they will sign off to say, yes, I am happy, this and this has been done. And we're happy that the accounts give a true and fair view. And that's a statutory requirement by company law. So all companies, bar the very small companies which you can get an audit exemption, because they feel it's just, for smaller companies, there's not as much a need for the audit because it's usually owner managed. So the owner is the person doing it day to day. So it's not that separation. However, when you get bigger, there can be that separation and there's more importance in terms of the financial system and the ecosystem to make sure that these accounts are audited so people can rely on them in terms of making decisions. So only the very small companies, and even if you're a small company, a lot of them may voluntarily get an audit because you can get some benefits out of it. Now, I've put some Financial Times articles up on Scoop It, particularly here, The Big Flaw, Auditing and Crisis, an excellent, I suppose, collection of articles around the problems with audit. Like if you follow the news around, for example, Carillion in the UK, Patisserie Valerie in the UK, a lot of companies had clean audits, they'd sign off on the report, and then 6 months later they went bust. So there's clearly question marks around independence, question marks around the industry that's set up, particularly around the big four, the big six firms, and how reliable it is or what the purpose of an audit should be. So that's something to think about and have a look. There's a nice collection of articles there if you're interested in them, in terms of how we're going to change the audit, where's it going in the future, the role of the big four. And there's also another very nice article, which I would strongly recommend, understanding the value of the audit. Like, what is an audit supposed to do in terms of is it supposed to find every single error? Is it supposed to only find the big errors? And where have these failures happened? Think of the Irish banks. Think of right the way back for anyone who's followed Enron, for example, at the start of the early 2000s, which essentially led from the big five accounting firms to become the big four. Arthur Andersen essentially fell, collapsed, and left with the big four: KPMG, PwC, Deloitte, and EY. But there was big five until the Enron scandal and all that came of that. But that has continued on in terms of scandals, and it's something that still has a problem overall in terms of the effectiveness of the audit. So have a read of that. Just understand, particularly that article around understanding the value of the audit. I think it's a very good one, and I strongly recommend it so you get an idea of the purpose of it and whether or not it's serving its purpose now in financial markets. The other thing to note is, I think I gave you a couple of examples there. Even in more recent times, there's been a lot of scandals where they've got clean bills of health from the auditor, and then 6 months later they've gone bust. So it's clearly question marks there around, well, what's an audit supposed to do and why hasn't it picked up on these? And the other thing to note is, even though you don't have to get an audit if you're a small company, it can give a lot of benefits. So you get the benefit of getting a professional team coming in, they're looking at your system and internal controls. It gives you credibility to investors or lenders. So you'll often see if you're a small company, you're looking to sell your business, there'll be a prerequisite to say, I want you to get an audit. Or if you're going for a tender maybe, or you're going to get a loan, the banks, they'll be looking for some credibility. They'll be looking for you to have audited set of financial statements. And that whole idea here, it's a very important concept. It builds trust. Trust between you and different stakeholders, whether it's lenders, investors, the government, employees. You're looking for that credibility. And that's a role of the audit can be very important there. Right, so just bear that in mind. The other thing I would suggest you take a look at is go back to a set of financial statements. So for example, Grafton Group that I have up there. If you go to the financial statement section, so there's all different sections of the annual report we'll talk about in a while. One of them will be the independent auditor's report. It's just before the financial statements always, and it's a letter from the auditor. So you can see a letter from the auditor here. I'll come down a second. The independent auditor report, they give their opinion. Are they happy with all the financial statements? They say how they came to that opinion and how they approached it and what the key issues were. So they identify the key problems in an audit. So what are the things that they're a bit concerned about and how did the audit procedures they did to make sure that they're happy. And then at the very end, it's actually signed off by the auditor. So you can see down here, the auditor for Grafton Group, should I say here, was PwC. Paul O'Connor, PricewaterhouseCoopers, signed the 11th of March. Just gives you an idea. The year end was December. They signed off within 2 months, maybe 9 weeks. So it's quite a turnaround to get that audit done of a big company like that. So it is important that you get an idea. Have a read of one of them at least, just to get a sense of what do the audit report on and what items do they raise. That'll be in every set of financial statements, and it's required unless you're a very small company. So the audit report and signing off on that. But you can imagine people signed off on Carillion's audit report. They signed off on Sports Direct. They signed off on Thomas Cook. But the problem is they went bust. Sports Direct was an interesting one. If you look at that article, they couldn't actually get an accounting firm to be their auditor. which is an indication itself, the auditors didn't want to take it on. They felt there was too much reputational risk. So that ended up going to a smaller firm. The problem is a lot of the smaller firms, if you look at the size of the big four, they're multiple sizes of the next tranche. So a lot of those smaller tranches, the next six, wouldn't have the resources to audit the biggest companies in the world because they wouldn't have that span of headcount or span of resources. That can be a very tricky position where the big four now are very focused on risk management, so they won't be taking on risky clients. And Sports Direct fell into the problem where they couldn't get an auditor for a while because no one wanted to take them on. They ended up going in with a smaller auditor. All right. So have a look at that article as well, understanding the value of the audit when you get a chance. So ultimately then, just to finish off this small recording, it's kind of the introduction, is we're going to now look at three sets of financial statements. Right? We're going to look at three different financial statements. The statement of financial position, which is looking at what you own and what you owe. So it's kind of like a statement of affairs at a point in time. We're going to look at the statement of profit or loss, which essentially says, well, did you make a profit or loss, about performance in the period. But be careful, it's an accounting's view of performance. What is profit, what is loss? Not the same as cash flow. Cash flow comes at the end, it's a separate statement. That's more like your bank account. What's the cash in and out during a period? So you might ask, why do we have two different statements about performance? One is about accounting performance, how we view profit or loss. One is about cash flow. We'll talk a lot about them now in the next couple of recordings as go in, but the whole idea of financial accounting is to give information to users, whether that's investors, creditors, lenders, about decisions. So it's about giving relevant information. All right. The other small thing just to finish up on is typically the accounting period here is a year. Now that doesn't mean that everyone has the same year end. So for example, Ryanair here, if you look at their accounts, we're going to be looking at them in a second. If you go back and look at Ryanair's accounts here, look at their financial statements, they have actually a year end of March, whereas other companies might have a year in December, etc. It just really depends. So you can see here, Ryanair, year end 31st of March. Other companies could have July, other companies could have December. Sometimes it depends on the business when they have, for example, resources to actually do stock takes, etc. Other times it might be depending on when the auditor is free. So they won't have a year end until they know the auditor is free after that to actually undertake the audit. So just bear in mind, most financial accounts will be annual. Listed companies will give quarterly financial statements as well, quarterly returns as part of the stock exchange requirements, and the year ends can vary just depending on what company and what the business is, what the kind of the seasonality is, but also maybe when the availability of the auditor is as well. Right, so that was the first recording as kind of a preparation for weeks 8 to 10, just setting the introduction. For the next three recordings then we're going to look at the financial statements. Statement of financial position, the first one, statement of profit and loss, the second one, and finally then the statement of cash flows and a small bit about annual reports to finish off and set you up for week 8. Right? So make sure you take a look at those and see you all on week 8.